Well, this is Jim Musgrave with Research Financial Strategies, and welcome to my last market update for 2015. Today is December 16th, and a historic date because after 7 years of extremely low interest rates, the Federal Reserve finally raised the federal funds rates just by 25 basis points. So generally speaking, this is good news because the Fed feels the economy is in good enough shape to handle a rate increase. But how will this rate increase affect your portfolio and your pocketbook? And how can we turn this nowhere market around and have a positive return for the end of the year? We'll see what happens, and I'll answer these questions and more in this market update. Okay, so if you just want the bottom line, here it is. So let me try to reduce this. There we go. And I'm going to get up some performance numbers right here. And you can see that this column G right here is column H is the year-to-date numbers. And the S&P 500 is our stock market benchmark. And so this is yesterday's numbers, not today's. So the S&P was down 75 basis points year-to-date yesterday. But we did have quite the rally today, so these numbers will have changed. But you can see that the NASDAQ has done pretty well, and also a strong dollar. And that has some ramifications with some other things that are going on I'll get to in just a little bit. But basically, it's very difficult to find sectors that are actually making money at this point, so you have to be very selective. So NASDAQ is doing well as the dollar. And you can also see here's the other benchmark. If you were in an 80-20 growth portfolio, you would also be about negative 75 basis points year to date. And ironically, if you were in a more conservative portfolio, you'd be down 10 more basis points at negative 85. And primarily that's because of that, the bonds as a whole have kind of really been challenged this year, and they're down negative 1.75. And we'll probably see some further deterioration of bonds as interest rates go up. Another sector, or small caps, are down about 5.8%. And small caps tend to be a somewhat of a leading indicator. So that's not terribly encouraging, but again, being down less than 6% is certainly not so bad. International. So internationally, things are in worse shape than the United States as a whole. But again, that's, it's not so good, but it's not so horrific either. So we've certainly seen some sluggish returns in international. But here's where things really start falling apart. In emerging markets, down negative 17 year to date, and really where the pain hits the road is commodities. And you can see just over the last 3 years, we've just seen a total deterioration of commodities, down nearly 50%. And so that's where you're going to be. That's where your oil and your energy is going to be, as well as precious metals. And they've just really taken it on the chin. Now, if you want to kind of break down into the U.S. markets, these are what I call the X's. And so these are the spiders. And you can see year to date that consumer discretionary is up over 9%. So this is a strong sector, and we currently own that in our portfolio. And we also have healthcare in positive territory, technology, as well as consumer staples. Here's our benchmark of the S&P 500. And then from there, it kind of falls downhill a little bit. So we've got financials, which actually should hopefully have a little bit of a rally since the interest rates are going to go up a little bit. So that's, we'll see what happens with financials. Industrials are down, materials are down, utilities are down, as well as obviously energy. That's an obvious one with the price of oil. So just to summarize it, going into 2016, I'll kind of go back here. We'll most likely end the year slightly positive for U.S. stocks. We'll be slightly negative for bonds. We'll be negative for international and emerging markets. Although with the ECB, lowering interest rates, international stocks may see a little bump there. So hopefully that'll happen. But also we're going to see more negative numbers in commodities and oil and energy and so forth. And so, one of the big things that I'm concerned about is obviously the oil and energy. And one of the top money managers or bond managers in the country is a guy named Jeffrey Gundlach. And this is from his presentation last week, and he had some great slides I want to share with you. So basically what's kind of going on is that, all right, so it's all about supply and demand. So the United States has a surplus of oil, and the major oil-producing countries want to discourage the U.S. from producing oil. So they keep on producing oil. And you can see that by this white line right here. And so when you have a surplus in oil, again, it's all supply and demand. So what the strategy for the Middle East countries and so forth is that if they can keep the price of oil low enough for long enough, that will kind of wash out some of the oil production in the United States and other countries, and so the price of oil will start coming back up to more reasonable rates. And so again, so if the companies stop, if U.S. companies stop drilling because it's not profitable and the price of oil goes up, that will that's sort of the idea from these other countries. The problem is that there's so much excess oil available that it's going to take years to consume the supply. And this is actually a very dangerous situation that may only get worse and could be one of the reasons for a significant pullback next year. So again, you're going to see, here's the oil prices and commodity. If I go to the next slide right here, you can see just this huge supply of oil. So this kind of breaks down the U.S. oil supplies from 2005 to the present. So you can just see this huge glut of oil that we have. So it's going to take a long time for it to go down. So again, it's nice when you go to the gas station to fill up your car, but there are some real economic ramifications to that. And just to kind of show you more in detail how that's affecting things, this is a 10-year weekly chart of oil. And you can see back here in 2008 how oil was extremely high. And you can see that here we are in mid-June of 2014, and you can just see this just sloping down negative trend. I mean, we've been below the 200-day moving average for years. So, I mean, this is about as bearish as you can get. I mean, the MACD is underneath the zero line. Our green line here is our market forecast. That's intermediate, and it's just in bearish territory. So that's oil. That's United States Oil Exchange. Now, if we look at energy, you're going to see, again, this is a 10-year chart. It's not as bad, but you can see that we've had about a 40% drop in energy from June 2014 to this actually last week right here. So that is a huge drop in energy prices. And you'll see some rallies right here, but one of the things is that learn. You live and learn. Sometimes this could be a dead cat bounce, and so we'll see maybe 6 or 7 trading days or a week or two of maybe a little rally in energy and oil, and then right now it just kind of reverts back. You see this huge candlestick going down to the downside. So and that's what makes this market so difficult to manage from a money manager, because you're so beaten down. You think, hey, maybe we've hit the bottom of oil, and it's a great value play to get in while things have been beaten up. So, if you kind of get in on this trend right here, you might have a rally, but all of a sudden it'll just reverse and head on down, and now you're down where you thought that it had turned around and there's the bottom. So this is a very, very tricky market, especially in energy. So, we've got a lot of, currents beneath the surface, and they're all moving. So I want to talk a little bit about monetary policy. So today, the Fed did raise interest rates, and this is a chart, so you can see where the Fed funds rate. Here we are, back in early 2000s, and then obviously the tech wreck happened, that recession. So you see how the Fed lowered rates and things got a little better. So the Fed started raising rates significantly and kind of kept them there. Then we had the last recession. That started in early '08, and the Fed was just plummeting the interest rates, and that's when we had quantitative easing, 1, 2, and 3, and so you can see the interest rates have been really low for quite some time. And actually today, the Fed felt that the economy has come a long way, but it's still has a long way to go. But basically they raised interest rates 25 basis points. And so now I actually watched Janet Yellen on CNBC today for her conference, her news conference, and again she was very, very clear that they're going to take a very cautious approach, and the rates will rise very gradually. So this chart right here shows sort of an expected trajectory of the rates going up, but this is only an estimated rate of incline. So obviously that we'll see what happens down the road. But I actually give the Fed a lot of credit. They've really understand what's going on with all the variables, and they felt that there's more risk of keeping rates low versus raising them at this point. So again, they're going to remain very, very accommodative for the foreseeable future, keeping rates well below the historical average for quite some time. And the market really, really liked that today, and I'll show you what the market did in just a second. But again, this is really good news, because if rates increase too quickly, there will be negative ramifications, such as elevated negative bond, or just again, there will be, bonds will underperform continually if the rates go up too quickly. There'll be a slowdown in the real estate markets. New construction will drop off. The unemployment rate may not improve as well as it has been, and so forth. And so, but let's kind of focus on the positive right here. So I'm going to take you to GDP. So currently the GDP has been about 2.25% over the last 3 quarters. That sort of not so, it's a very average, or kind of, quite frankly, actually a little bit below average GDP. And one of the reasons for that is the strong dollar and weak international demand. Again, the United States is one of the stronger economies in the world right now, and the rest of the world isn't doing so well. And so again, this is a global economy, and so again, it goes back to supply and demand. So if countries outside the U.S. are not consuming as many U.S. goods and services, then obviously the earnings and the GDP are going to be muted, and that's exactly what you're seeing here on this chart. Okay, take you to another slide right here in terms of the unemployment wages. So one of the reasons why the Fed's starting to feel comfortable about things is that the unemployment rate has dropped significantly from about 10% in 2009 to just around, actually it's about 5% today. This slide was as of September. So that's actually a very, again, it's a positive sign in terms of the unemployment rate, dropping. So that's very good. And let's see, what else? Go on to the inflation. So the Fed has a dual mandate. One is to keep unemployment low and also keep inflation low. So inflation is very low. You see high headline CPI very, very low at 0.2%, which historically it's far below the 4.2% 50-year average. So inflation remains very low, but as oil and energy start to strengthen and the dollar tends to weaken, that's when we're going to see inflation. And so some of the other good things that are going on in the economy is that we also have cyclical sectors. So we have light vehicle sales that have had a nice steady increase since back in 2009. So that's a good sign. Housing starts are going in the right direction, so that's a good sign. Manufacturing and trade inventory. So obviously if companies have more inventories, they feel that there's going to be a demand for them. So that's a good sign. The one thing that's a little concerning is the real capital good orders, and you can see that things have fallen off a little bit here in 2014, 2015, and I think that is due to the high dollar and again, the goods and services being more expensive for international people to purchase our goods and so forth. So anyway, so those are some of the positive things that are going on in the economy. So people think, well, hey, if the Fed raises interest rates, what has happened in the past? Well, historically, periods following the interest rates have been relatively strong in terms of the stock market. That hasn't always been the case. You can see here in June 2000 and July 2006, you can see that the Fed raised interest rates, and then the market started to fall off. Again, these were, as I've mentioned many times, that bear markets happen on average every 5 years, and so kind of during this period, that was the period between the two recessions. So as Feds raise interest rates, and then we come into a recession, and things start to fall. And again, that's one of the reasons why the Fed wants to get off of interest rates of zero, because if we do get into another pullback or recession, they want to have a little bit of wiggle room to lower interest rates and kind of juice the economy again. And so that's again, one of the things that they're balancing is kind of getting off zero, but not throwing the markets into a tailspin. So anyway, so we've had several years, and you can see on the top charts that the stock market has done very, very well as the interest rates go up, but it can also happen the opposite direction. So again, we really don't know, but I just want to kind of show it could go either way. Okay, so I'm going to kind of move on to a couple of the charts right here that I want to kind of share with you. And one thing I want to show you is the S&P 500. And again, I want to kind of show you some charts and kind of give you a long-term perspective on what's happening. So I put this little note right here. So here we are on October the 7th, 2007. And you can see S&P was at 1565. The MACD was kind of going sideways, and we were still in a very, very bullish territory in our midterm intermediate market forecast. We had kind of hit a higher level here, but we were starting to kind of drop. And you can see, the MACD crossed here, and we really started losing steam. And then obviously things turned around, and we've had a really nice run, fairly even from 2012 up until last year. And you can see the market forecast, went from very bearish to very, fairly bullish for this period of time. But you can see there are some similarities to what's going on here in 2015 to where we were in 2007. So you can see that the MACD has crossed over, and also the bullish sentiment has also started to lose a little steam. And as a fact, I kind of marked right here, the market forecast green line was higher in October 2007 than it is today. So things are kind of starting to turn over a little bit. And so, is this the beginning of a bear market? It's a little too early to say at this point, but you definitely have to kind of keep that in mind, because we're about 6.5 years into a bull market. Here we are, March the 6th or March the 9th, 2009, and we get into here March of 2016. That's 7 years. That's way long in the tooth for a bull market. But technically, we're still in a bull market. But you can see we've had choppy waters this year. So I want you to. So obviously, and I'm going to kind of go into this a little tighter so you can kind of see what's going on. I'm just going to put up a year-to-date chart on a daily chart. So I put this line here at 2100, and you can see that we've had nothing but being in this trading range. So it's crossed 2100 multiple times, and then here we are in August, where the S&P in 1, 2, 3, 4, 5, 6 trading days lost 12.5%. And you can see that this is an extremely volatile period. And again, if I go back to my 10-year, if I can get my mouse to do what it's supposed to do, 10-year weekly chart, you can see that gets us all the way back here to April of 2014. And we just wiped out, almost a year and a half's worth of gains in like, 6 trading days. And now things are starting to come up, but you can see that we're having a hard time getting past this resistance line on the S&P 500. And so we've had all this chop right here and all this uncertainty. And let me just kind of zoom in a little bit, and I'll go again into a daily chart. I'll just do a 1-month daily, and you can see with the Fed, good news, we've had a nice rally. So what the pattern has been is that we have a nice rally, it touches around 2100 and then comes back down. And so, hopefully we'll have a good rally between now and the end of the year. And if we can just break this 2100 on the S&P and it stays there, that's actually a very bullish sign. And, then again, that would mean that our bull market will continue to be in a bull market, and obviously until it changes. But the good thing is that we've got a cross on the MACD right here, and our intermediate line on the S&P is starting to kind of come up a little bit. So that's kind of where we are with the S&P 500. I'm going to kind of go back just a little bit here. A couple of things I want to kind of share with you is I want to kind of go over the small caps, which again, the small caps have actually struggled a little bit more. You can see here we are in June of this year. So small caps have been lagging large caps, but again, we've had a nice little rally. And one thing that kind of gives me some hope is that this little cluster right here, where you have all these lines converging, is what we call a bullish cluster. And so you can see this big drop in the small caps for the last couple of weeks, but they've all converged, and you can see that things are really shot up. So we're about to get across on the MACD. We're starting to get up, but really what I want to see is I want to see us break this first of all, this resistance right in here, which we have. The next one is I want to see the resistance, right here around, 116. And if we can really break it up here at about 120, then that'll be very, very bullish. Whether it happens or not, it still remains to be seen. But, hopefully I'm going to keep my fingers crossed that this momentum will continue. But, if it kind of rolls over and starts turning down, that's a fairly bearish sign, and hopefully that won't happen. But that certainly, could happen, and I'd be a little worried at that point. So I want to hit some of the sectors that, this is what I call my leading economic indicators. And I want to kind of show you that it's very, very tricky to invest right now because the things that are doing well, obviously the S&P 500, and some of the sectors that I just showed you like XLY, but across the board, let's look at, I'm just going to hit these really fast. So these are the transportation. I'll even go back even further. Let's just go back and do I'll do a 5-year weekly chart. So transportation, here we go back to about a year ago. You can see that up until this point, we've had a nice rally, nice bullish rally. But with transports, we've seen the momentum switch. And again, this is a leading indicator because, again, goods and services need to travel by truck, train, plane, and ship. And when we see these, these sectors drop, that is a bearish, not a positive economic sign. So that is a bit worrisome on that. The other thing I want to kind of point out, I already talked about oil. I'm just going to show you oil again. Again, this is the scary, scary chart. It just keeps on dropping. And this is just the commodity index as a whole, the broad commodity index. You can see that's really in negative territory, and it hasn't bottomed out yet. So that is a very worrisome leading indicator right there, as commodities are just continuing to get crushed. Another thing that I'm concerned about is copper. Okay, copper is another leading indicator. So you can see that we're well below the 200-day moving average. Our market forecast, this is as bearish as you can get. Again, copper is a commodity, but I want you to think about something for a second. So copper is in copper wires, copper pipe, and when you have periods of expansion, typically there's a demand for copper. So, China is slowed down significantly. Russia slowed down. Brazil has slowed down. I want to show you the slides down the road in just a few minutes. But, with this decrease in demand internationally, that is being reflected here in copper. The other thing is that here is the dollar. Okay, you can see the dollar has just been very, very strong. It's been a little choppy with this uncertainty here, but again, the momentum is still going in the positive direction. And so if the dollar continues to go up and be stronger, that's going to put continued pressure on valuations and earnings on U.S. companies, and that could also continue to be a drag on GDP and also the stock market performance. So again, as the dollar goes up, that is that's not a great sign for equities and commodities. One of the things that's also very worrisome are junk bonds. So you can see right here, back in 2014, they kind of peaked. Actually, technically, they peaked back here in 2013. But we've seen this massive sell-off because there's been a lack of liquidity in the high yield and the junk bond markets. And so this is very, very concerning. And because a lot of times these, actually one of the big mutual funds, I think Third Street, just cut off all redemptions from their mutual funds because there's a big run on the bank and there's lack of liquidity. So junk bonds are, this is a worrisome indicator right now that does not make me feel all warm and fuzzy inside. Again, I talked about emerging markets. They've been going sideways and they've been really, really dropping. That's a lot to do with the rising dollar, the strong dollar. ITB is home construction. Now, actually, this isn't a bad-looking chart considering where the market is. So new home sales have actually been somewhat consistent this year. So this is actually, I kind of put this in on the positive note for the economy. It's still a little choppy, but I'll take it. XRT is retail. This is a very bearish sign. So you think here we are a week from Christmas, and you would think that the retail sales would be in their busiest time of year. Well, in the busiest time of year, but obviously the sales aren't showing that. So this is certainly a sign of a slowing down economy that does not give me the warm and fuzzy. Okay, so the retail sales is another economic indicator that's just is very, very worrisome. And again, this is just sort of the international ETF. You can see that's really taken a big hit, over the year or so. So just to kind of hit the different sectors and some of the things that kind of worry me, and I kind of showed you the charts. I want to go back to this double line presentation and just show you a couple different things that I'm concerned about. So you can see here that so what is this slide here? Oh, okay, what this is the net profit margin for here we go. Here, the net profit margin for the overall economy is still kind of sluggish right here. And we go on to 27, and we have the net profit margins. So what we have circled here is all these times where, again, 1985 was the only period when a 60 basis point decline in the profit margins did not coincide with or predict a recession. So this is the only time right here in 1985 where the decline in the profit margins did not predict or coincide with the recession. So here we are in 2015. So that's a little concerning, right there. We kind of forward on to the global economy. Apparently, oh, apologize. Well, actually, let me just kind of go back here a little bit. I'm actually working off his. Here we go. And here's the junk bonds that I just kind of talked about, how they just continued to fall. That's certainly a bearish sign. The high yield spreads are very high. That's not a good economic sign. The average loan, leverage loan average price is also dropping, another negative sign. And we kind of get onto the debt. Actually, I'm not going to, well, I'll just kind of hit this real briefly here. The reason why we bring up the debt slides is that, remember, so the Federal Reserve is borrowing, is basically lending money to the Treasury, and the Treasury actually has to pay, these loans back with interest. So as the interest increases on the interest rate, obviously that's more interest that the Treasury actually has to pay back to borrow money. And so you can see that this public debt is going to continue to increase, and that's so actually rising interest rates is also going to increase our national debt. So not very happy about that. Again, we have all these different things that we went through, but I want to kind of go on to right here. So we kind of talked about the global economy. I'll show you some more charts. So here's the Shanghai stock market composite. We had this crazy rally where the market went up like 60% or something like that, and then within 2 months it just dropped. So this was a huge shock to the Chinese stock market. And the next slide, here's China's business activity. Obviously, it's also dropping. It's not nearly as strong as it was in years past. So you can see China is the second largest economy in the world, and when they're slowing down, that certainly affects us and many other countries. Brazil GDP, they are basically in a recession at this point. I believe they are the 7th largest economy in the world, and so they are doing horribly. And again, I just kind of showed you the emerging market slide on my charts, but you can also see that this chart also reflects emerging markets continue to struggle and fall. And again, I've hit this several times tonight already, with commodity prices just continue to drop. And again, another chart showing the strong dollar. And also in terms of the energy, again, I just showed you that slide a couple minutes ago. And in terms of the verdict, you can see really where the fixed income is going is that the blue lines are also year-to-date in 2015. So convertibles are up pretty well at almost 1%. High yields have been taking a hit, negative 2.3. International emerging markets are up a little bit. Corporates are about even, and so forth. So you can see we've had some low single digits. And we go on to the next slide. Then we get into the less safe paper, and the CCC rated high yields. Look at that, down 11% as of, when was that? I'm trying to read the footnotes right here. Yeah, as of December 4th. Well, I can tell you what, there's been more of a run on the bank since December 4th, so I know this number is much greater than it is. So again, fixed income is very, very difficult at this point. Where you want to be is in very safe, low duration positions, U.S. Treasuries, short duration, investment grade, corporate grade, being convertibles. Those sorts of asset classes will tend to do better in a period of rising interest rates. So let's see, what other pages right here? And that's really, oh, and I got one more slide I want to kind of show you that kind of shows another kind of bearish, sign, which I'm not terribly excited about. And that is this basically margin debt. And so you can see right here that if you actually invert the S&P 500, it is very, very well correlated to margin debt. So what margin debt is that if you got a margin account and you want to borrow money to buy stock, for example, you buy stuff on margin. Now what happens is that when people feel confident and very good about the market, they tend to buy stuff on margin. Conversely, when the market starts to fall and people don't feel confident, or you get a margin call, then that margin debt declines. And you can kind of see right here in 2008, 2009, you see this nice this green part of the chart where it says August 2008. That's when positive credit balance versus negative credit balance. And so you can see that where we are in 2015 and right at this point, we have current levels of margin debt that exceed the last two recessions. And that is a very scary chart. And you can see that it's already, that the S&P is already starting to invert and drop. So those are signs that quite frankly are very bearish, that I don't like to see. So anyway, that is my report for this last market report for 2015. I'm going to try to do these every month, but again, just to kind of recap, we've been doing okay with the market, but there are definitely some gray clouds on the horizon. And again, if the S&P can get above this 2100 and stay there, that's a fairly bullish sign. But again, if it kind of rolls over, and especially if it drops below this 1850 mark, that is extremely bearish. And so again, if you have any questions or comments, you can certainly give me a call at 301-588-0514, or just send me an email. Again, you can reach me by going to my website and hit contact, and I'm happy to answer any questions that you have. So for the time being, listen, you have a wonderful holiday, Christmas and New Year's, and we will certainly catch up with you in 2016. Good night.